With us to talk about it is Julia Cordano. She's the president and founder of MacroPolicy Perspectives. What number are you looking for? What are the sort of numbers underneath the numbers that you think we should be paying attention to?
Yeah, so we're a little bit below the Bloomberg consensus at 2%, but that's still a pretty impressive showing given the year that we had and how far the Fed tightened policy and how much we lost on fiscal support. We're looking for consumer resilience, but definite slowing. We had a cautious holiday shopping season. So I think we're looking at growth that's, right around trend, slightly below trend under the hood. Obviously, residential investment is going to be a big negative, and interest-sensitive sectors more generally are showing the strains of higher rates. And that gets 2023 off to a pretty sluggish start. So the most recent data, December data on consumer spending, showed a lot of caution and reluctance to spend.
We've been living in this sort of Jay Powell, bad news is bad news, good news is bad news situation. Is that going to turn here?
Yeah, I think, look, we've seen enough slowing in the economy and, very importantly, enough good news on inflation that the Fed is comfortable stepping down. They're still tightening, but not at the speed of last year. We're expecting a 25 basis point rate hike next week. And, maybe one or two after that. We're not far from the peak funds rate. And then the Fed plans to just hold it there for a while and let the economy struggle through a period of sluggish growth or a recession. And I think right now that's a pretty close call.
So you're not in the category of thinking that things are actually going to be better than maybe, when I say better, that's why I say better could be worse. And that's sort of the strange part about this.
Yeah.
But hotter may be the better word to use here.
So we are in the soft landing camp. Let me be clear. We have been, and I think the data are rolling in consistent with that. The important key to this is that the job market has been so resilient. We have seen aggregate hours worked decline. So the work week is declining. There's layoffs in some sectors. And overall, labor demand is cooling off, but we haven't seen mass layoffs. We haven't seen the unemployment rate rise, and yet we're seeing wage growth moderate. And that's the key for the Fed. If the Fed can sort of take its foot off the neck of the economy and just pause, even at this higher level of rates, which is a drag on activity, but stop tightening. And we think that will happen at the end of Q1, but that March will be the last rate hike. Then I think that gives the economy enough room to breathe. One of the keys to the outlook here is productivity. It's been pretty abysmal through the pandemic. And most recent indications are that productivity may be picking up. There's been a lot of investment. Turnover of workers is slowing down. What do you think? And supply chain frictions are easing.
Real quick, what do you think the unemployment rate ultimately goes to?
We don't have it going above 4%. So that's a near miss as far as a recession is concerned. Once you've risen half a percentage point or more, you're in a recession. We think we skirt that, that we will get some increase in unemployment, but not enough to. So we're kind of looking like a mid-90s scenario rather than a full-blown recession, kind of a soft patch, and then we kind of enter the next phase of the expansion.